So right now, the three biggest economies in the world, the U.S., Europe, and China, are all kind of troubled and uncertain. Where can an investor turn for a little comfort? David, I'll start with you because you're a global guy, but I want everybody to respond.
Well, the fact that we have this uncertainty present today is actually good for an equity investor, especially one that has a value bent as we do. So we'd rather be buying stocks at low prices, and in order to get quality at low prices, economic uncertainty and macroeconomic instability is actually very good for us. So if you have a medium or long-term investment horizon, which I would argue is what investing is all about, this is a very good time. So whether it's European equities, U.S. blue chips, Japanese stocks, the only area that looks stressed from a price perspective, and they're not overpriced, but they look stressed, is the emerging world.
Right. Well, Justin, the emerging world is where you spend a lot of time. Do you find investing comfort there?
Well, I agree with David that controversy represents meaningful opportunity because it really is about entry price in terms of, as an investor rather than a speculator, opportunities. I think that that's not broadly true in emerging markets. I think that there are meaningful opportunities. The world's bifurcated at the moment, as one can appreciate, and part of that's financial repression, which is global. So every tagline for investors now is about yield, right? Equities, because there's no yield in the world. And unfortunately, we've got this bifurcation where extremely durable circumstances, which tend to have high quality and reasonable yields, are actually very expensive. And I would say that's true broadly in emerging markets. However, there are controversies throughout the emerging markets, and I think China is perhaps the one really significant area of controversy. There's a lot of concern about political transition. There's enormous concern about where normalized growth will be after a decade of double-digit growth. And there's actually a lot of concern about accounting difficulties, corporate governance in China, and there's some really wonderful companies. So I think China within the emerging world. I think in the United States there are significant opportunities. Now, I'm an emerging market investor, but I think that would be the other area I would look.
Steve, you look very broadly at everything that's available. Where do you find a little comfort for investors?
Well, right now I don't find a lot of comfort. We're actually fairly near-term bearish, which is our first time we've pulled back on equities since 2008. So we've been overweight all through here, but we are nervous that the U.S. economy is slowing. We think people are really on the pause button due to what's going on in Washington, and it's coming at the same time that you've got a slowdown in China, Europe heading into recession, and then Sandy, unfortunately, doesn't help either. So near term, we're telling people to be cautious. However, we still think we're in a secular bull market for equities. And we think the second half of 2013 could be pretty good. You're going to have a lot of pent-up demand released on the economy, presuming Washington finally comes to a long-term agreement on tax policy and entitlements. Europe probably enters a recovery mode, and the Chinese transition. I mean, we've started to buy China for the first time in 2 years now. So we think within the emerging world where we're underweight, but certainly China we think could be interesting here, and it has gone through a 2-year bear market. But right. I also agree with David that we think the best place to invest right now is the U.S. And what we're telling people is hold your fire next couple of months, but you're going to get a great opportunity in global cyclicals. In that period, and we think there's a big move up still ahead of us in the S&P.
Savita, U.S. equities are your focus. You agree with what's been said?
I do. I think that I actually think that right now is actually a good time to think about sort of diversifying your country exposure, because what's been interesting over the last year is that it seems like the market has focused on one issue at a time. At the beginning of the year it was Europe. As the year progressed, China started to show some cracks, and only now are investors focused on the fiscal cliff and the problems that it poses for the U.S. economy. I think what this year has shown us is that no country is without its problems, and it might be time to actually diversify your global exposure. In the U.S., what I think is kind of interesting is that U.S. equities, with any whiff of foreign exposure, have sold off significantly over the year and are now trading at a pretty attractive valuation. So I think this is actually a good entry point for buying some of the global cyclicals that could be a lot cheaper than they were about a year or two ago.
Some people overlook the fact that you can be a very global investor through U.S. equities.
Right, exactly. So, I mean, 40% of sales of U.S. companies or more are derived from overseas. So the U.S. is not a direct play on our economy. It's actually a pretty globally diversified equity market.
Yeah. Dan, bonds are your focus.
Right.
I have to ask you the big question about bonds, which is the conventional view has been for years now that interest rates have to go up, and they keep not going up, and the Fed has decreed near zero rates as far as the eye can see. When will the prediction come true?
Oh, I wish I knew. I mean, let's face it, bonds are priced in general higher than a kite, and specifically most of them too. So common sense tells you that when, as and if the major central banks, plural, the reserve countries, back off, rates will probably go up. There are some arguments for lower rates in the future, and they're strong, but the net outcome, I think the strongest argument is for higher rates, maybe not like the late 70s, I hope not, but a secular uptrend in interest rates. Now, that's the bad news. It's also the good news. You learn how to do this when you're out and about long enough, particularly with bonds.
Yes.
You say, take your focus away from the lousy income today and the horrifying capital loss that might be in front of you, and focus on the good news. And the good news, literally, depending on how you run the portfolio, is hopefully interest rates will go up in the future and reinvestment returns will rise. Right. For 30-some years now, we've been beaten down by forever declining reinvestment rates. Total return looks great, current income gets worse. And for people who are shareholders in fixed income mutual funds, they like their NAVs and hate the income. Right. Now we're in the bottoming phase, and maybe a trend on up. Do you have to change portfolios? You darn betcha you do. Right. And do you have to do it in advance? Yes. Right. And can you do it in advance without sacrificing too much? Yes. Notice the
slightly hesitant yes.
If this were a CFA speech, I'd say, well, it's very easy. You substitute specific risk for market risk. Yeah, you can pass the exam with that. Doing it is a whole nother thing, and it does require patience. It's like, let me put it this way, Jeff. It's like raising teenagers. Eventually this will end, right?
Right.
You're not sure quite when.
Right. But it must.
Right. And you're dealing with very specific risk in the meantime.
Right.
And that's the nature of bonds today. Bonds, by their nature, are not exciting. I mean, stocks are exciting.
Yeah.
But you can make darn good money in bonds if you think ahead. I grew up in an environment where interest rates always went up. I'll leave you with that.